What we're going to talk about in the next two sessions is, as it's entitled, New Frontiers in Technology Infrastructure. And I guess our first panel session is going to look at sort of winners and losers and try and define who and where they may be. And I just wanted to pick up something that was said earlier on, and I think it was Clive Furness who raised this point generally, that the thing about technology is we tend to do everything by numbers. The black box does it. There's a certain amount of human oversight, but basically the black box does it. Have we actually lost that sense of intuitive feel about the shape of the marketplace? Because we're all busy behind a screen, and we're not actually there. So, and I remember the transition, when the transition happened from open outcry to electronic trading, those who supported open outcry used to say, well, you'll lose this feel of the marketplace. You won't be able to look people in the eyes. You won't be able to see the sweat on their brow. You won't, all of that kind of thing. And there may be, sorry, I'm just paying you a compliment here, Clive, by saying you've raised something about technology and market feel. And so I guess that's my first question to the panelists. Are we at risk of losing that real sense of market feel as to what its best shape should be by going too technological?
Thanks. I think the way I look at it is that it's, yes, there is a big sense of market feel that is lost because people aren't seeing each other and so on and so forth. However, I've, in the context of our exchange, I spent a lot of time meeting and visiting and spending a lot of time with very sophisticated firms, high-frequency traders, and I've looked at what their infrastructure looks like, and it is staggering. It is absolutely staggering the amount of markets they look at in order to regain the feel that we think is lost. So these are people who typically, the orders are sent out through algo engines and so on and so forth. But the way they keep their pulse on the market is quite staggering. So in a way, I ask myself, have we really lost the feel? We're replacing it with a different way of keeping our fingers on the pulse. And I think that's what it is. It's just gone more electronic, but the finger on the pulse, it's becoming more difficult to keep your finger on the pulse because markets are global, they are electronic, they are also fragmented in many ways. So you need to track a lot more things, a lot more venues. You need to understand very different dynamics, but people are overcoming that by, they have found ways in which they can keep the finger on the pulse to try and get. So I think I think firms have evolved in terms of building the infrastructure that is necessary to keep an eye on things.
Okay, I don't think so. At all this has happened. I mean, in the case of a person who used to be sitting in the pit and trading over there in an open outcry environment, he could lose that touch for a while. But in fact, on the contrary, I would say, there's so many people, like an average person now sees more through technology. He has news on his fingertips, he has Bloomberg, he has Reuters, he has everything. And he has then decision-making processes that are running within the machines, which can actually take care of his decisions while he's sleeping. So it has empowered the average user much more than, or probably as close to a professional trader who used to be in the 70s or in the 60s in the pit. So in that sense, I think there's more empowerment through technology rather than losing that touch, the human touch that was prevalent.
Paul?
I think in many markets, the movement to full-on electronic was an evolution. I think those of us who got a few grey hairs may recall perhaps going on into open outcry floors, from open outcry floors to exchanges that actually put booths with terminals in for the members, so everyone could still go in, sit in the booths perhaps and trade, but also have some sort of social interaction, and progressively move it away from that to electronic. Those human interface for trading is gone. It's dead. It can never come back. But what are we seeing? We're seeing at one end, we're seeing markets where things are moving so quickly, you can't look at the screen because you won't see anything. At the other end, we're seeing specialist markets where indeed, yes, you can keep a track with the human eye of what's going on. The thing in between is the ability of people who are tasked with providing a window into the markets for the exchange or for the broker, the way these people are able to put the human touch into the electronic wizardry. The way that there's been progressively uptake of the use of modern technologies and modern ways of delivering information. More and more now, I think we're seeing graphical representations of what's going on in markets, the ability to instantly see strange situations and such like, which I'm sure we'll talk about in one of the later topics. But it is now, it's the positioning, it's the ability of people who are working in the trading environments to interpret the needs of their owners, their bosses, in providing windows into the market that are recognizable by humans.
Okay. Let me come to the first question, actually, because I was interested in this first question about, is technology the key to future success or a painful financial headache? It's got to be both, hasn't it? I mean, it can't be one or the other, because the more you improve your technology, the more deeper you're going to dip into your pockets. And I would assume there may come a point of no return. I mean, some people have said in high-frequency trading, for example, it can't get much faster, but the amount of money you have to spend to make it go much faster, that's a game of no return. Is there some truth in that? Is there a point at which this is not really going to help that much?
I think the marginal benefit is going to reduce definitely as we get to a stage where there is only as much as you can squeeze out, and the investments required to get the marginal benefit are going to be staggering. They're going to be huge. So that is going to be challenged. But then again, what we see today, we didn't anticipate 5 years earlier. So the kind of technology that we will see 5 years from here, from 5 years from now, is going to be probably a new paradigm as well. So I think it's going to be increasingly difficult to predict whether we'll have seen a max out on squeezing out benefits.
So we're into thought trading. Think it and it's done on the market. Sorry,
absolutely.
right?
Yeah, I mean, for a commodity exchange, technology, in my mind, is never a headache. You could never term it in that manner. I mean, commodity exchanges are never a glamorous sort of thing in the economy. And although we continue to hear the futures and all that stuff and a lot of terminology, but at the end of the day, it's the farmers who are working, and we might be sitting in very posh localities and discussing that, but really the stream starts from there. So technology is probably the only glamorous part of the commodity exchange, unlike the equity exchanges, which are always in the limelight, and people are looking at them daily, almost everyone. So from an inside perspective, we never see technology as a headache. In fact, we see it as one of the most important things that our exchange should acquire.
Okay, Paul. Game of diminishing returns?
An obvious statement, but perhaps we are making a lot of obvious statements on this panel. I think some of this is real common sense, but you've got to know who you are. So you're an exchange. You've got to know who you are. You've got to know the game you're playing in, and you've got to set your objectives subject to the benchmarks. And really, sometimes you hear horror stories. I've heard exchanges, smaller single country, not even regional exchanges, who've gone out for a global standard, if you like, a big system from a big supplier, and then find they can't afford the payments. Buying a car that's too big for you is probably a simple analogy. In the end, it's an arms race, and make sure you're in the right race, and you get on at the right place. Otherwise, you end up wasting far too much money and really having to bail out, expensive decision, and then realign yourself with technology that is right for what you're going to do. So understand what you're going to use it for, understand what you're trying to achieve in your market. You can still achieve quality and good connectivity, acceptable processing speeds, etc., without having to resort to the largest investments with the largest products.
Okay, you talked about common sense. One of the things that I get the impression of is regulators are becoming very fearful of technology in the marketplace. It's all too automated, it's too fast. When they talk about high-frequency traders, these are people who are gaming the market. It's not real liquidity, it's shallow liquidity. They're scalping the market. You get all this kind of thing. And probably the underlying fear of the regulators is it's too fast to manage. Unless the risk is moving at the same speed as the execution process, potentially we have a problem building up. Now, that is one side of the argument that we haven't really addressed, which we've talked about the rationale of becoming more technologically successful. Do you think that this is a real concern, that the regulators are lagging way behind, if you like, what's happening in the marketplace and haven't got into the psychology of what's happening in the marketplace, but standing back and saying, we don't like the way this is going, we're frightened about this, we want to throw grit in the wheels, slow it all down. Do you get this impression of that?
I think there are two aspects from a regulator's perspective on this. One is the fact that the markets are moving too fast, and their own expertise in understanding what is going on, how it is happening, and their ability to regulate is being challenged because of the speed at which it's moving. But I think that is one part which will only evolve over time. But the more important concern that they have, which I think is a very valid concern, is one of fair investor protection. So it creates, high-frequency trading creates a skew in the marketplace where there are very sophisticated traders on one end of the spectrum, and then you do, because it's an exchange and it allows participation from multiple investors and multiple traders, you have the people who still punch keys on a keyboard, and the sort of traditional investors who still participate in the market. And the regulators fear that the skew is not favoring the traditional investors, and that is, I think, a worrying fact, and I don't think we found an answer for that as yet. And that is the same concern that regulators had about OTC markets, which was wholesale, all the things that went that were sort of thrown against OTC markets, which was opaque wholesale markets. Customers didn't have a feel for what was going on. Is it going to be recreated in an exchange environment because of the extreme skew of what kind of players are going to dominate price discovery? And I think that is a fair concern.
Okay, Amjad.
Yeah, see, the thing is that this speed and volume in the markets cannot be stopped. It's inevitable. This is going to continue like this. See, the thing is, we tend to look at the exchanges first. The real carriers of this velocity are the networks. Basically, the network is the exchange. So now we have borderless trading. People sitting in Pakistan are trading with US brokers and things like that. And there are large populations who have come forward recently, connected through MCX or DGCX or PMEX. South Asia is a highly populated area. So even if you did not have this HFT and all that stuff and algo trading and that kind of thing, the sheer number of new market entrants who are coming into these markets are actually synthetically going to create the effect of an HFT. Mm-hmm. So it's inevitable. The regulators will have to step in and see what's going on. I don't know if they can do much about it or not, because they have to give equal access to everyone. And technology is only going to make things easy and easier and easier for the new entrants to enter the markets in the most sophisticated ways.
Okay. Paul, just taking this a step further, this whole process, it sort of largely starts with the wish that we must execute as fast as possible, and we must be as close to the exchange as we possibly can be. There's nothing new in that. That's been going on for about the last 150 years, when people were riding horses almost, and they were trading, you know, who had the fastest horse and which could get to the exchange quickest. So there's an inevitability about all of this. But can the risk management controls keep up?
I think yes. If people can develop systems that are capable of putting millions of transactions or millions of orders a day successfully onto markets, we won't even talk about the 80–90% of those millions that are actually immediately gone. That's another debate. But people are capable of developing those systems, so it surely must be possible, and it is possible, for surveillance systems and initially surveillance systems. It's a bit late by the time you get to risk management. I mean, I think surveillance systems are now equally fast as trading systems. Interestingly, the more and more of the people that develop high-speed trading systems, particularly for exchanges, are also developing the surveillance systems. And I think there's a logic in that. Oh gosh, we've just, you know, we can let you put all these orders in, by the way, we better manage what's going on. And perhaps as markets get faster and fuller, there might be an argument for the Australian or the Canadian central surveillance model. Maybe the central regulator has a rules-based approach, leaving the exchange to adopt a principles-based approach, but both with equally capable systems, filtering out the manipulative and not so level transactions orders right at source, making it a little bit easier for risk management systems, which are the ones that I think need the investment and the increase in capability, because I think that's where there could be a lag given the amount of calculations they have to do.
Okay, let's come to the position more of exchanges, in the sense that as they get more and more technological, they start to begin to fall over a bit here and there, either because of the complexity of the systems they have in place, or because the systems can't cope with sudden increases in volume flow. I mean, let me just ask the three of you, in terms of how you manage that, what I call fall-down risk, which seems to be exhibited in a number of exchanges recently, what kind of controls and sort of recovery programs have you sort of got in place to minimize that risk?
From our perspective, I think it goes back to the point he made, which is very valid, which is as an exchange, we have to know who our stakeholder audiences and what our constituency is and what are their requirements, and fine-tune our approach to that, to their needs. In order to keep a fair market going, rather than to aspire to be, the most state-of-the-art and the best in the world and cutting-edge technology. Those are all wish lists that are not relevant in our case. So we try and look at this not as a technology solution, but as a business solution. So what is it that our constituents require? I mean, technology can do what we need it to do. It's a question of investment, but it's really what are the business solutions and the business processes and the frameworks we need to put in place. So it could go back to the point that was made at an earlier session, which was things like order-to-trade ratios, position management, risk management, collateral management. So there's a range of sort of business processes and business rules, and that I think is the more important way to, at least for us, given that we can customize it to suit the needs of our audience rather than aspire to be, the latest and the best.
Okay, Amjad. Fit for purpose.
Yep.
Yeah. Okay. So that's an important observation. Like on our exchange, a case in point is we received a bad tick in one of the gold contracts, and there's a $100 dip, okay, because of which a lot of stop loss orders, GTC orders got triggered, okay, and then after 2 seconds, the rates go back up, okay, and people go and check at CME here and there, there's no dip, nothing, so they start calling in, what's the problem, what's going to happen to my trades. And we have to step in and tell them, okay, we are going to clean up everything and it's going to go back to normal. So meanwhile, clients are not able to see the correct liquidity on their terminals, so they are unable to trade as they should. So that's a big problem for the exchange. So in principle, we decided that we need to have a system that if, for example, a bad tick arrives, we need to do a reverse as quickly as possible. So we need to have a system that can actually delete trades, through and through, recalculate all the net liquidities and everything. Take the clearinghouse also on board, send them all the new data and everything, and all the reporting, the terminals, everything should be aligned and properly, fixed within seconds. So in order to do that, we'll have to make some technological effort so that, if anything like this happens, we can do the reversals as soon as possible. So that kind of effort the exchanges will have to do.
Okay, Paul.
Yeah, so I mean it's quite clear, and I agree that with both those statements that fundamentally you build your processes, use the technology to build the processes to ensure that when glitches happen, recovery to normality is something that is reasonably straightforward, that being able to get information to the market that this is going to happen, just create the right processes to unwind situations that perhaps shouldn't have happened. However, and one step beyond that is make sure that the core technology is robust, and never mind having glitches and price changes, make sure it doesn't fall over. And we have seen a number of markets in the last couple of years that have stopped, have fallen over. There have been press bulletins, I think they're on record. And they've been for, well, only the people inside know the real reasons, but there is no reason why, with the technology that's being used today and the technology available to the people that develop today, why, notwithstanding outrageous spikes, conditions should be able to be managed and systems should be robust. Now I come from a market that is not high frequency trading, European power and energy, but we pride ourselves that our core matching software achieves 5 nines uptime. Take away the nasty beast and the threat of network failure and other non-core activities, that core system, and I think it should apply across the board, should be robust at least to 3 nines. You can then start managing situations that occur outside the core, and particularly networks and connectivities, where I think some of the biggest problems could be hiding, potential problems could be hiding. That, and also information dissemination, where we've seen failures in markets around the world with prices just not getting back out through the sources. So design the systems well, test them well, and understand that the likelihood of failure is going to be in the early days. So really test beyond where you're going to be in the early period.
Okay. Questions? Anybody got any questions they want to ask? Right. Oh, yes. Do you not disagree with what you've heard? Maybe you think you're sitting there fuming with rage. Obviously not. Right. Clive.
I'd like to ask the exchanges on the panel, would you consider charging for order flow for high-frequency traders if it's clogging up your bandwidth?
It's another form of taxation on order flow.
Yeah.
Just you get the benefit, not the governments.
Yeah. No, I don't think so, because like in our case, we have market makers who are in the common definition of a high-frequency trader. They qualify as a high-frequency trader. So 99.9% of the time, they have the passive orders, and clients have the aggressive orders. They are coming in and matching. So if we are going to tax the market maker, that's going to basically kill the market. So I don't think so. And I'm not too sure, how much of the time there could be. See, there are 2 kinds of HFTs in my understanding. There are ones like the market makers who are doing arbitrage across exchanges, across markets, across regions. and providing liquidity, they're the good guys. But you might have, the predatory ones who look at inefficiencies in the market, and just because they are sitting near the core of the exchange or the matching engine of the exchange, they have some advantage. That, to my mind, is not the spirit of trading. So, that kind of thing might be bad. But then taxing anyone, without that differentiation would not be correct.
But let me pause, Amjad. Is that a slightly dangerous argument? Because basically, no one is going to say it's wrong for you to take technological advantage. I mean, that's. And you were flirting with that slightly.
Yeah. It's not wrong. I agree with that. It's not wrong, but to an ordinary trader, we need to give some sort of level playing field. Now, people sitting with 10 gig connections, co-located, that they are purely taking advantage of the infrastructure that they have. So there is no actual, effort as far as the trading dynamics and the economics are concerned of the product. It's purely that you have a better machine. That's why you're able to win. So it's not the race between the machines. If you're a better informed trader, that is acceptable. But you're right. We cannot stop because somebody has better technology. We cannot stop him. But at the back of my mind, I'll still have some resentment towards that kind of behavior.
But
and especially if it enters the realm of predatory techniques, which
I can see a bit about that. But we used to have tiered pits, and people used to complain. I was the centre of the pit, or am I sort of somewhere out there in the periphery, and the guy who's in the middle has got no. I hear what you say. Okay. Does anyone want to comment on this? Yes.
Yeah, I'd like to point out earlier. Mr. Khan gave the example of how gold dropped. Was it 200 ticks or something like that, and came back within 2 minutes?
Yeah, we had a bad tick of $100 down, and then next it remained like 2 ticks, and then the third tick was back up.
Can I perhaps put it to you that maybe it's the high-frequency traders who have the ability to jump into the market very quickly before other people? They're exactly the people who brought the market back into line very quickly?
Yeah, that is a possibility. It could be a mistake as well, But generally, then the market would tend to look at other jurisdictions because gold is traded across the world, and they would say in 9 other countries this dip, was not seen. So it's something the market maker has, gone wrong, or something wrong with your systems. So there you'll have to, back off.
But surely the speed that the opportunity or that market was brought back into line with the other markets is basically it's just a simple mean reverting trade, right? And you've got to allow these guys in the market to allow them to take advantages of inefficiency in order to obtain a fair market.
Yeah, I'm not saying that these people should not be allowed. I'm not proposing that. So again, you see, even if you do not allow them to behave in whatever way they behave, somebody is going to come and do that thing anyway. So whether it's a machine or human being or 10,000 other people trading on one matching engine, to an outside person, it's going to look like some sort of algo is trading behind this. So I'm not saying that we should abolish, or I do not agree with what HFT sort of trading does. I'm not saying that.
I think it's a bit like, a lot of end users now are into algo trading. And I suspect high-frequency trading is going to percolate as the skill set gets wider and more people start doing it, I suspect it will be more commonly used. I would imagine a bit like the telephone, it was the preserve of a few, and then suddenly everybody had one. So I think it might be a bit like that.
Yeah, so I mean, today's specialist will have to know the gold fundamentals, he'll have to know the political news, he'll have to know all other economic news, what the dollar is doing, and he'll have to know what technology is doing, and you know what the other guy's technology is. And then, I mean, that's a whole different topic. If I have an algo that is running, and you know, I'm an ordinary person, I made an algo and I have a trading system that's trading. And you are a sophisticated bank or JP Morgan or something, and you know, you start studying my algos and try to, you know, pin those on the wall and you know, launch an attack against my algo. I mean,
what's wrong with that?
So we are getting into some sort of a war that is detached from the, you know, trading and the fundamentals of the commodity itself.
Okay, right. I know what you're going to say. Trading has always been a war. When has it ever been anything other than a war? But so let me shift the conversation a bit to the regulators, because we have a problem here that there's going to be huge amounts of data that are going to be going into the regulators now in terms of transaction reporting requirements, information, all sorts of things, prudential regulation on a real-time basis. And yet, constantly we hear this refrain that the regulators haven't got the systems in place to manage all this data. So it's all very well saying, give us all your data, but it's absolutely pointless if you can't actually manage it for the purposes for which you're requesting it. Do you think there's some truth in that, or do you think we're being a little unfair?
No, absolutely. I think it is very, very difficult, especially for regulators in emerging market jurisdictions, to keep pace with capability, capacity to understand what's going on, because their markets are already trading 5 years ahead of their own capability to deal with such or to regulate such markets. So you're absolutely right. It is a concern. It is a big concern, and often that's where the exchanges have a hat of being an SRO, step in and proactively work with regulators, educate regulators, provide proactively tools, research, information to regulators to keep them in tune with what's going on. So that concern has got to be taken on board by exchanges, and the regulators have got to be brought on board in a proactive manner.
I mean, one of the ways that regulators used to defend themselves is to say, we don't want any defensive reporting of data. So in other words, you push as much data away as you can because you can't analyze it all. But what do you think? Do you find the same problem?
Yeah, I mean, absolutely true. I mean, in Pakistan, regulators fall far behind the exchanges themselves. The speed of execution, the surveillance falls behind, and normally they would push us to do the surveillance ourselves rather than them doing. And you know, we are the frontline regulator anyway, so we have that responsibility. We owe that to the market. In 2005-06, there were crashes in the stock market in Pakistan, and the regulator did not have the tools and the expertise to really go into the data and find out who did what. So they hired our team from the exchange, from the derivatives exchange, to actually do an investigation in the equities exchange and try to let them visualize what went wrong, who did what, was there connivance among the brokers to drive the market up or down. And we had to go in and simple things. But all they had was, simple trades coming in and sitting in their databases. So they didn't have any visualization software or anything like that that could really tell them, how things were moving. So that's absolutely correct. And I think regulators will always continue to fall behind. It's not the case. See, they're not in the business directly. So somebody sitting in one of the brokerage houses will design something, think something. We will think of a product. We'll go to the regulator. They will, talk to us, have discussions for 6 months, and then say, okay, this is approved, because our chairman talked to their chairman, so therefore, it gets approved. But they don't know how to really look at the things.
Okay.
So they'll always be behind, and from the exchange's perspective, it's a human tendency. We would want them to be behind, so they don't know what's going on, and we continue to do our business until something like a catastrophic event happens.
Right. Paul, this is a universal problem, isn't it? I mean, it applies in the West as much as it does anywhere else.
It applies everywhere, and this is all it's very familiar words. I think the regulators should stop complaining. I think the regulators should grow up, come into the real world, make the right investments. The technology is all out there. Even in Europe, we've seen half-cocked approaches in certain markets where, let's just get the trades. Well, what about the orders? The trades on their own are not good enough. I think it's time that the regulators really got on top of what they're doing, and the political will is there to get everything onto a level playing field, as it were. Well, give the regulator some money. Let the regulator go out and employ some poachers.
I'm not sure Amjad would quite agree with that, actually. I think keep them
no,
at a distance.
fair enough.
We already pay them a lot.
10%
of our...
Absolutely. I wouldn't expect anyone to agree, but let them employ some poachers, and get on with the job that they're there to do. Otherwise, we'll even have local regulatory arbitrage.
Yeah, exactly.
And there are markets, I know, where regulators fall out amongst themselves and slow markets down. That's the other problem. The commodity regulator wants it. But no, it's financial services, so the financial services regulator wants it. I think every geography's got that argument. Pointless. Regulators really want their heads knocking together.
Okay, right. We'll finish on that note. Regulators need their heads knocking together. Right, who's going to do it? That's what I want to know. Right, well, look, we're going to finish there because I think we're time barred from any more. So a round of applause for our panelists. Thank you very much, guys. Thank you.